In this video, we're going to be looking at using the treasury method to determine the dilutive effect of stock options. Stock options allow the holder to buy a share of a company stock at a set price sometime in the future. These were extensively used by tech companies in the latter half of the 20th century and in the beginning of 2000, 2001. Uh, these companies reported EPSs uh, with a disregard to the effect of the potential dilution, because that was GAAP at the time. When the tech stock bubble uh, popped, many investors lost significant value in their stock, and one of the things that was looked at was the effect that paying executives and workers in stock options hid the fact that there was a potential for many more shares of stocks to be issued, therefore greatly reducing earnings per share. Reduced earnings per share has an impact on the market price of the stock. So GAAP, along with requiring the expensing of stock options that are given as part of compensation, also required that companies report the diluted earnings per share. In this exercise, uh, we have stock options that are fully vested, and they have an exercise price of $50 per share. So go ahead up and set up an Excel spreadsheet that looks like this. Pause the video and come back when we're ready. So our exercise price is $50 per share. There are 24,000 options outstanding. For the treasury stock method, which is used to determine the dilutive effect of the options, not all 24,000 will be considered diluted. We will determine the amount of cash that is available to purchase common stock, and that is the number of options times the exercise price. So this company has $1,200,000 potentially available to go out in the open market and purchase stock. Now, the problem tells us that the average price of common stock was $60. If that is not given, often you'll get the market price at the beginning of the year and the market price at the end of the year. To determine the average, you add the two together, the beginning and the ending stock prices, and divide by 2. In this case, it is given as $60 per share. So if we have $1,200,000 and the average price is $60 per share, how many shares can we buy? Well, that's simply the cash available divided by the average price. So we have the potential of buying 20,000 shares. Therefore, the dilutive effect is simply the options outstanding less the treasury stock. Many critics of GAAP feel that this is too conservative. Or is not conservative enough, I should say. There is no requirement that the company take the exercise cash and use it to buy treasury stock. Many argue that the full amount of the option should be the dilutive amount, but that is not what GAAP currently is.